Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to forward exchange contract designated as cash flow hedge from time the contract is made to settlement. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to enter the data into the blue area on the right-hand side, including our journal entry, and then our trial balance worksheets will extend from year 1 and year 2. The data will extend to 2 years of time frame. So we have our information, says the forward exchange contract. We're going to be working with a forward exchange contract. Timeline will be that we have a forecasted transaction, which is going to be on 8/1/X1, forecast the purchase of goods and enter into a 240-day forward contract to hedge the foreign currency purchase. So we're going to say that there's going to be a transaction that's going to happen in the future. We don't have a contract for it, but we believe that there's going to be a transaction in the future, and it's going to extend for 240 days. So from that point, this point in time, 8/1 to the end of that transaction, to the end the actual payment will be made. It'll be an accounts payable, will be 240 days. That's going to be the same time frame that we will set up the forward contract for. Then we have the exposed foreign contract payable at this point, because that's when the actual transaction takes place, in that on 10/1/X1, we're going to get the goods. We're going to get the inventory. Therefore, we have actually received the inventory at that point in time. And we have a financial transaction that we will then put on the books that we had anticipated happening before, but didn't have a contract, but now it actually happened. So we're going to put it on the books at this point, but we're putting it on the books on account, meaning we're going to be paying for it in the future, like a normal on-account kind of setup, except that we're going to be paying it in foreign currency, paying it in yen. And then on 12/31/X1, we're going to have a balance sheet date where we will have to revalue our exchange rates at that point. And then on 4/1/X2, we're going to pay the account payable in yen with foreign currency units received from the completion of the forward exchange contract. In other words, the forward exchange contract will become due at the same point in time because we set it up to be 240 days, which will end at the same point in time that the payable that will happen. It will provide us with the currency that we need, the yen that we will need to then pay off the payable that we promised to pay in the currency of yen. So let's go over this a little bit more. We're going to say on 8/1/X1, P, that's us, agree purchase goods from a Japanese company. We're going to buy from a Japanese company. We're going to be an American company. Therefore, we put our books on the books using US dollars. And the transaction is going to be for something that's in another currency, in this case, yen. The purchase is a forecast, but there's no binding agreement for this purchase. So on 8/1, we think that the purchase is going to happen, inventory in the future. We have a good idea it's going to take place, but there's no binding agreement that it's going to take place. On 10/1/X1, 60 days delivered will happen. So 60 days later, in other words, we're saying on 10/1/X1, the inventory is now delivered. So now we have an actual financial transaction because we actually have the inventory, but we're putting on the books on account. Remember, we're going to pay it later, and we're going to be paying it in yen. That's going to be the 3 million yen, which I'm actually going to move over to the outside here. And then on 4/1/X2, 100 days after the delivery, payment to be made. So we're going to end this thing off on 4/1/X2. On 8/1/X1, P entered into that 240-day contract. That's the forward exchange contract. And that's because it's the 60-day time period you're thinking before we actually got the inventory. And then the 180 days, which is where the payable was on the books. And that's going to be our forward exchange contract. It'll be for the 300,000 the 3 million yen as well. The forward rate for a 240-day forward contract is 0.0073 to 1 yen. Reasons for, and I'm not going to have the reason, we're going to go down here. This is going to be our forward exchange spot rates, or our spot rate and our forward exchange rates for the relevant dates. And then we just want to note that the forward contract designated as a cash flow hedge from the time the contract is initially made until the settlement date. So this is going to be a lot similar to a previous practice problem that we have worked. This is going to be the differentiating factor. The forward contract designated as a cash flow hedge from the time the contract is initially made until the settlement date. This should be included in the red text. Okay, let's walk through this then. We're going to first put the forward contract on the books on 8/1. So remember, at this point in time, we've said, hey, we're going to purchase inventory. We're pretty confident about it. It's going to push forward, but we don't have an actual formal contract, but we're confident it's going to happen. So we're going to put the forward the forecast transaction or the forward contract on the books. To do that, we're basically going to record a receivable and a payable at the same point in time. So we're going to be here. We're going to say, all right, the receivable is going to be the foreign currency receivable from the exchange broker, and then the payable is going to be the dollars payable to the exchange broker. Then we're going to say the receivable is going to be in yen, so that's how we're going to get the yen in the future. We want 3 million yen in the future. The payable we're going to put on today's, basically the exchange rate we use today, which will be the forward rate, and then we're just going to leave it in terms of dollars. So here, I'll put a little dollar sign by this to say this one's going to be in dollars. So let's pull out the trusty calculator and do some calculation with it. So the trusty calculator is up and hovering in another screen, so I'm going to pull that thing on down. And we're going to be using the forward rate. So it's 8-1. We're using the forward rate. Remember, we're kind of projecting out into the future to when this thing's going to end 240 days later, which is also going to match the end of this transaction, which is going to be on April 1st, 2000x2. So we're going to be using the predictive rate, 3 million times the 0.0073, the 0.0073. And that's going to be the 21,900. 21,900. Let's do that up top. Let's do the same calculation in this cell by saying equals to this 3 million. We'll pick up the 3 million right there on the way down. And we're going to be picking up that 0.0073. That's going to be the 21,900. There's the debit. There's the credit. Let's put this on the books. So we're going to say this is going to be the receivable side. This thing is in foreign currency that we're going to get, so we're going to have to adjust this receivable as the rates change, as time passes, given the change in the exchange rate. However, this payable, we're going to go to this payable, is not going to change because we're going to set it right there at that amount. So this is going to be paid in dollars. This is going to be paid to us in yen. So the variance that we have will be on the receivable side of things. Next, on 10-1, we had the actual delivery of the inventory. So it did happen. We got the inventory. We're going to put it on the books. Basically the same way we would normally put the inventory on the books if we were to purchase it on account, meaning we're going to pay for it later. We're going to say we got the inventory. Credit's going to be accounts payable. One minor detail, however, we need to indicate that the payable is going to be in yen. We got to pay the thing in yen rather than in dollars. So that means that we want to mark that in the payable. We're still going to value it in terms of dollars, but we're going to have to value the actual yen that we're going to be paying, and therefore that payable will vary due to the changes in the exchange rates. So let's go on down. We're going to say now we got the inventory. Now whenever we get the inventory, even though we have not yet paid for it, we're going to value basically the inventory as of the point in time that we got it, and that's using the spot rate. We're not projecting out into the future until we pay for it. We're just basically using the current exchange rate as if we paid cash for it at this time. So 3 million times the 0.0065, that's going to be the 19,500. But that's wrong. Sorry about that. It's that because we're at 10-1. We're not at 8-1. So it's really going to be the 3 million times the current spot rate, because right now, today, in our problem world, is 10-1, October 1st. So I'm going to multiply it times that spot rate, 0.007, and that's going to be the 21,000. So 21,000. Let's do that calculation up top again. We're going to be up top. We're going to say this is going to be equal to, we'll pick up that 3 million and then say times, scrolling on down, we're going to be picking up that 10-1 rate, the 0.007. So there's the 21 and the 21. Let's go ahead and post that out. So we'll have the inventory going on the books now. We're going to put the inventory on the books at that 21, valued at that 21, and then we have the accounts payable is going to be on the books. This is going to be equal to the accounts payable. Remember, that's not normal accounts payable because we have to pay it in yen, and therefore this number will change with the fluctuation of the rates, foreign rates, and so will this number, but this number will not. This number right here will not because it's in dollars. Okay, so then we're going to say it's 12/31, end of the year. We're going to have to revalue our accounts that will fluctuate, which we just pointed out the two, the receivable here and the payable there will then change. So let's do that. We're going to say, all right, now it's 12:31. Time has passed. Time is flying by. We're going to say it's 12:31 at this point, and we're going to revalue this item. So this is the receivables on the books at the 21,900 now, and now it's 12:31. So we're going to say it should be 3 million times, and now it's 12:31, and we're using the forward rate for the receivable because that's the forward exchange contract still predicting out into the future to that point in time, which is 90 days later at this point at 41x2. So the 3 million times the 0.0077 is going to be the 23.1. So the 23.1 minus what's currently in there, the 21.9, is going to be a difference of 1,200. That 1,200 is going to be a gain. Why is it a gain? Well, because last time we were up here on 8.1 for the receivable, and it was 1 yen was worth $0.0073. Now 1 yen down here in December is worth $0.077. Therefore, the yen has gotten stronger because it's worth more dollars. 1 yen's worth more dollars. And this is a receivable we're talking about, which we're going to get paid in the currency of yen, which is now stronger. So that means that we're going to have it's going to be a gain that's going to happen. So the two accounts that'll be involved, I'll add these again. We're going to say it's going to be the foreign currency receivable is going to go up then by that 1,200. The other side then not going to the gain here, but rather to this other comprehensive income. So we're going to be putting this into the other comprehensive income. Let's calculate it again. We're going to say this will be equal to, scrolling on down, and take the bigger of the two numbers we will be dealing with, which is the 0.007 minus the 0.003, brackets, closing that up, times, and then we'll multiply it times the 3 million there. Let's see, I'm missing a bracket. I'm missing a bracket. There we go. Okay, so there's the 1,200. There's the debit and the credit. Let's move the calculator out of the way and see if we can go ahead and post this thing out. So we have the receivable up top. Let's do that first. Something's in it, so I'm going to double click on it, go to the end of it, say plus, pick up that 1,200 on the receivable. Then we have the other comprehensive income. I'm going to go down here on the income statement side of things, picking up the 1,200 there. All right, now in the receivable, we now have that 23,100. Just to recalculate that one more time, that should be the 3 million times the forward rate of 0.0077. So there's the 23.1 once again. We're going to do a similar process for the accounts payable. So we'll see, okay, we got the accounts payable here. This is in the foreign currency, the 21, and we'll do the similar process. We're going to take the spot rate at December at this point. So we're going to be taking the 3 million times the spot rate at December, which is 0.008. And that's going to be the 24. So we're at 24 minus what's currently in there, which is the 21,000. So we have a $3,000 difference. That is going to be a loss, which is what we would expect because it would be the opposite of what happened up top here. And so then let's think about why it would be a loss as well down here. We're going to say, well, last time it was 1 yen was worth $0.007. Now 1 yen is worth $0.008. The yen has gotten stronger. Now we're talking about a payable, which we're making in the format of yen. And therefore, we're paying something that's going to be stronger than it was before. So we have a loss. So we're going to say, all right, then we've got the loss we're going to put up top, foreign currency loss. Other side is going to go to the payable. So we got the payable. Let's calculate it again by saying equals brackets, picking up that 3 million, and multiply or minus. Let's do that one more time. We're going to say this equals brackets. Let's pick up the rates first. So we'll go down to the rates down here. Take the bigger of the two rates, the 0.008, minus the last rate we used was the 0.007, and then close up the brackets. Now multiply it times the 3 million, and that will give us our 3,000, and then that's going to be the debit and the credit. Let's move the calculator out of the way so we can post this thing. We're going to say that we have the foreign currency loss. That's going to be down here on the income statement, equal to the 3,000, bringing that on over. Then we have the accounts payable. We're going to put that up top. Accounts payable, go into the end of it, plus we're going to pick up that 3,000 That'll increase it to the 24,000. That 24,000 calculated one more time to be the 3 million times the spot rate at December 0.007, which is that 24,000. Okay, so then we're going to basically move it out of the income statement basically down to the comprehensive income here. So we're going to say, all right, now I'm just basically going to record comprehensive income, other comprehensive income, and offset it with a gain. So I'm going to offset the thing with a gain and push it on down to the other comprehensive income. So notice what we're not doing. We're not basically putting it into a firm commitment, and we're not going to, so that we can put it into the inventory. We're not changing the original inventory amount. We're putting it into other comprehensive income. It'll accumulate forward in other comprehensive income, and then it will affect, we're going to see, it will affect the cost of goods sold then when we actually make the sale. So that's how we'll deal with it here. So we're going to say, all right, now we're going, this is going to be for the same 3,000 debit and credit, other comprehensive income, something is in it. So I'm going to double click on it, go to the end of it and say plus, pick up that 3,000. And then the other side is going to go to the gain. The gain's going to be up top. We'll put that here. This is going to be equal to the credit of the 3,000. That'll put us back in balance. Okay, so now we're going to go to the next year because that's when everything, is paid off and the forward contract's going to end. All like the exciting things happen now. So now we're going to say that here's the ending balances for year one. These are going to be the beginning balances now for year two. And I left out the comprehensive income. I'm going to roll that into basically equity up top. So equity is going to include everything, including the rolling over of the other comprehensive income. So I'm going to say, all right, this is the post-closing trial balance. So we got the post-closing trial balance is, and then the equity section is here in all of equity. We're going to include here, including the other comprehensive income that rolled in from the prior period. Okay, so then we have the current information down below, and we can just keep on pushing forward with this. So next thing's going to happen is on 4/1. We're going to have to make the payment. Everything's going to happen. So therefore, we're going to have to make this adjustment once again. So let's adjust the receivable again. We're going to say, all right, now time has passed, and now it's April 1st. And so we're going to say then that this should be the 3 million times the current date. Usually we're looking for the forward rate, but we're not this time because it is that date. So we're not looking into the future because it's now. We're in the now. So there's the 3 million times the 0.0073 or 76. That's going to be the 22.8. What's currently in there is the 23.1. So minus the 23.1, that's going to give us a $300 difference. So we're going to say, all right, that $300 difference is going to be a loss, by the way. It's going to be a loss. Why would it be a loss? Because last time it was 1 yen was 0.077 dollars, and now 1 yen is worth $0.0076. So the yen got weaker because you get less dollars for every yen, and we're getting paid in yen, which means we're getting paid in something that is now weaker, and so that's not good, resulting in a loss. But we're not going to put it to the normal loss. We're going to put it into the other comprehensive income section. So we're putting it into the other comprehensive income. Other side then going to decreasing the receivable due to that loss. We're going to say this will be equal to brackets. We'll calculate this $300 the second way. Once again, we're going to say it's going to be the 0.008 spot rate. That's not right. Hold on. It's going to be the last forward rate, 0.0077 minus the 0.0076. Close up the brackets, multiply it times that 3 million. There's the 300 debit and the credit. Let's move the calculator out of the way and see if we can post this thing out. Other comprehensive income is going to be on down here. Other comprehensive income. We'll pick up that $300 debit. Then we've got the foreign currency receivable here. This is going to be equal to that amount. There's the 22.8. We're going to see that a lot. Let's once again calculate the 22.8, which is going to be the 3 million times the 0.0076. So there's the 22.8 once again. Now we're going to do the same thing for the payable here. So we've got the payable down below. We've got to adjust that to the current time period, which once again is going to be the same calculation, right? Because even though we're using the spot rates over here. It's now, it's the current date. It's this point in time. So this is all going to start pushing to the same number. So we got the 3 million once again times the 0.0076, 22.8. 22.8 minus what's currently in there, the 24,000. So that means there's going to be an adjustment of 1,200. That's going to be a loss, and it's going to be actually that's going to be a gain, which would make sense because that would be the opposite of what we had here. And then if we think about it this way, we would say, all right, well, last time we had 1 yen was worth $0.008, and now 1 yen is worth $0.0076. So 1 yen is now worth less dollars. The yen has gotten weaker. So the yen's gotten weaker, and we're talking about a payable here. So we're gonna make payments in yen in something that now is worth less at the point in time we're making the payment. So that would result in a gain. So then let's move this out of the way. We're gonna say the payable is gonna have to go down. We're gonna decrease the payable. The other side's gonna go to the gain on the foreign currency. Let's calculate it again. This is going to be equal to brackets, and let's subtract out our rates. I'm going to take the larger minus the smaller, the two rates we'll be dealing with. The 0.008 minus the 0.0076. Close up the brackets, multiplying that times the $3 million. So there's the debit of the 1,002 and the credit. Let's go ahead and post this out. We got the payable first. Here's going to be the payable. This is going to be equal to that 1,200. Then we have the gain. That's going to be on down below. The gain down here is going to be equal to the credit of the 1,002. The payable is now at that familiar number, that 22.8. And yes, let's go ahead and calculate the 22.8. That's going to be the 3 million times, once again, that 0.0076 spot rate as of April 1st, the current time period we're working in. Now, we're going to have to revalue this thing. As we've seen in the past, we're going to continue with this process, basically removing the gain by netting it out with a loss, and then we're going to basically move it into the other comprehensive income. And that's going to be for the 1,200. So here's the foreign currency transaction loss we're going to record. This is going to be equal to, we'll pick up this amount. That'll basically net out the gain and the loss here, of course. And then we got the other comprehensive income, which we're going to be saying is E plus, picking up that 1,200, and there we have that. So now we're going to pay off this payable down here to the broker. I'm just going to show the dollar sign. I just want to show the dollar sign on this account to show that this amount hasn't changed. The forward contract is now over now. The time period, the 240 days, has now been ended. This number has been the same the whole time because this is like what we put it on the thing on there for at the very start. Didn't change because it's in dollars. Nothing special, nothing fancy is going on here. We just said we're going to pay that amount, and now we have to pay it in dollars. So there's the 21.9. We're going to pay it with cash. So we're going to debit the dollars payable. We're going to be crediting the cash. And we could pick this up multiple ways. The number, you could say, well, it's just the negative of that number. We're going to pay it off. If you want, or you could say, where did I get that number from? We got it from this first journal entry up here. You can pick it up from there. That might help you to think about it. Or you can recalculate it again if you think that would be helpful for you to go back and take a look at. It was calculated at the 3 million times the forward rate when we first made the forward contract at, there's the 21.9. Let's go ahead and post this. So here's the dollar payable. So that's going to be here. That's going to be bringing this amount down to 0 now. That amount now then going to 0. That looks good. Then the cash is going to be going down. I missed it, but you see where I was aiming. And this is going to be equal to the 21.9. And so that cash then goes down. Then we're going to get the currency. We're going to get the forward contract is going to pay us now in the foreign currency. So that's represented by this 22.8 here. Now remember, we revalued that 22.8 to reflect the 3 million that we're going to get in yen in the current value, in the current value of it. So this 22.8 we're going to get now, but we're really getting yen, which we're valuing at the current spot rate to be 22.8. So we're going to then say that we're getting paid in that. So we're getting like money, but not cash. We're getting what they promised to give us, foreign currency units, which, I mean, you can value it, you can think of it just like stocks or anything else. We're going to value it in terms of dollars on our side. So we're going to get stuff, which happens to be other currency, which we're going to value in dollars. And then this receivable is going to go down because they paid us the stuff they promised that they were going to pay us in. So there's the 22.8, which we can calculate by saying it's going to be the 3 million times the 0.0076. There's the debit and the credit. Let's go ahead and post this out. We're going to say the debit's going to go into the foreign currency. This is going to be equal to, once again, the 22.8. Other side going into the receivable. Something's in it. Double clicking on it, saying plus. We're going to pick up that 22.8 here, bringing that amount down to 0. So at this point, we have the cash here. We've got the foreign currency, the 22.8, which represents our valuation in dollars of the 3 million that we're holding on to in yen. So we're yen millionaires, but it is 22.8 in US dollars. And then we have the foreign currency receivable from the exchange broker back down to 0 because they paid us off. The inventory is on the books right now at the 21,000. So it's on the books at the 21,000, which is up here, which you'll recall we put this on the books when we received the inventory at the spot rate at that point in time. Hasn't changed since that point in time. The inventory is still there. However, we will see a little kind of twist on this because we're going to consider what would happen when we make the sale on this. Then we've got the accounts payable here. Now we're going to be paying off the accounts payable because we have the foreign currency now in units and we have the accounts payable in the units that we need to be paying it off in. So let's go ahead and do that. We're going to say, all right, the accounts payable is going to be debited, and we're going to be paying it off with the foreign currency units. And once again, we're going to be using that 22.8. We're actually going to be paying the 3 million yen. Let's calculate the 22.8 one more time. 3 million times the current spot rate, 0.0076. There's the debit. There's the credit. Let's post out the accounts payable. It's going to go right here. Double clicking on that, going to the end of it. Plus, that's 22.8 and enter, bringing it on down to 0. Foreign currency in units. Here we go. Something's in it. Double clicking on it, going to the end of it. Plus, picking up that 22.8 on the credit side, bringing it down to 0. So there we have that. Now we just got the inventory on the books, and there we have it. Now, one more kind of twist on this. Now, the major point here is the inventory is on the books at basically the spot rate when we actually receive the inventory. And then we said that we've been posting some of the gain here. You can see to the other comprehensive income, part of which for the prior year rolled into. Notice all the gains and losses were netted out and then basically netted into the other comprehensive income, which rolled into, we put into all of the equity in here. And we did the same thing here. This thing is netting out, and then basically it's in the other comprehensive income, right? So now we have other comprehensive income. And now when we make the sale, we're basically going to include that in the sales price. Therefore, let's imagine that we're going to sell this inventory. So we sell the inventory. I'm not going to record the first half, the sales half, where we get cash or accounts receivable, and then the other side would go to revenue. And then we would have to deal with taking the inventory off the books. Now, as we take the inventory off the books, it would look something like this, right? We would say, all right, well, cost of goods sold would go off the books. And if we sold all the inventory, then it's going to go off the books at, we're going to pick up the 21,000 here. So this is going to be equal to the 21,000 would go off the books and the inventory would go off. That's what we would expect if we sold this stuff, right? We'd say, all right, well, as part of the sale, the inventory would then go down, so it would be down to 0, and then the cost of goods sold would be on the other side on the income statement. However, we're also going to include the effect on the other comprehensive income, both from the prior year, which rolled into basically other comprehensive included in the equity section, and then in the current year, which is going to be this 900 down below. So let's do that here. We're gonna have to then include. We're gonna say the cost of goods sold is going to be affected by cost of goods sold, and then I'm going to pick up the other comprehensive income here. So that's going to be in this one. I'm going to say, and I could just type in the 900, but I want to recalculate it so when you're looking at the Excel worksheet that you'll be able to see it. So that's going to be this plus this. So there we have that. I'm going to make it a positive number, so I'm going to put brackets around it. So that's going to be that one. And then on the other side, we have, in equity, we have other comprehensive income here as well. And that's going to be what's constituting this amount from the prior period that rolled into there. So we're going to say this is going to be, so that's a debit, so we need a credit here. This is going to be equal to negative brackets, and I'm going to say this number plus this number, which is only going to be, it's just going to be that 1,800 credit, right? And so the difference then is going to be affecting the cost of goods sold. Cost of goods sold then is going to be the negative sum plug of this thing, and there's the 900. So this is kind of like the twist on it. Notice the inventory didn't change at all. We put it to other comprehensive income, recognizing it in other comprehensive income in the temporary accounts as we went, but we're still going to make that adjustment basically once we make the sale then to the cost of goods sold, reversing it out of the other comprehensive income. So we're going to say, all right, then cost of goods sold is going to be plus this 900. Other comprehensive income in the current period is going to be this 900, and then the comprehensive income that rolled into the equity section up top is going to be that 1,800.